Welcome. Even as Indian equity indexes are touching new highs, Morgan Stanley has written a bunch of reports showing how the global center of gravity for growth is shifting in favor of Asia ex-China, excluding China. For instance, Asia's PMI manufacturing is outstripping that of China, Europe and US. Likewise, FDI flows, although they're globally falling, Asia's share has risen to 55% from 35% pre-COVID. Separately, Morgan Stanley also sees only one more rate hike from the Fed in this cycle. I mean, that's important by way of backdrop. So what will this global backdrop of a slowing China, a healthy Asia and an end to rate cuts in the US mean to India? I have with me Chetan Ahya, Chief Asia Economist at Morgan Stanley. Chetan, thank you very much indeed for joining us. First, if you can bolster this argument, Asia ex-China best place to be?
Yeah, absolutely. I think, in the context where, US and Europe both will have to see some slowdown, central banks are taking policy rates higher. They do want to contain their domestic demand. In that environment, I think Asia ex-China offers that great opportunity where growth rates are reasonably strong and it's being driven by domestic demand. So agree with you, Latha. I think this is the part of the world that is going to hold up better in the backdrop that we have for global economy.
Okay. So what's your sense about what a slowing China and a definitely slowing US, even if the rate cuts are over, the impact of 500 or 525 basis points will be felt in the days to come. So a slowing world, what impact can it have on, say, India? Do you see that pulling down a few basis points of the GDP?
Well, I think, the impact is coming in essentially from exports and trade slowdown. And we've already seen that come through in the numbers. You saw India's exports in June contracted meaningfully. And that's happening, across the world. But the trade aspect is something that we have considered in our forecast for India as well as for region. An argument for that, growth outperformance or strength is really coming in from stronger domestic demand. And I think that story is still continuing despite this weakness that we're going to get from external demand.
So where are you all pitching India growth now?
We are still forecasting 6.5% for, on an average for 2023 and 2024 calendar year.
Okay. So that's perhaps you're the only person who is almost with the Reserve Bank. Several others are a few notches lower. Can we just finish off the currency argument? We have seen the seminal fall in both the dollar index and in the yuan. Does that pose any appreciation risk for the rupee? Because an appreciated rupee can be a double whammy for growth.
So I think it will depend upon how RBI approaches this. We are seeing a rise in portfolio flows, and portfolio flows tend to be a big important factor in terms of the currency swing on a short-term basis. And the RBI has been keeping the currency quite stable. In fact, the FX traders have been surprised how stable the rupee has been between 82 and 83. But I think essentially the flows will be managed by the RBI and they're keeping the currency in a stable range. So the outlook is for rupee very much in a stable range, Latha.
Okay, so not that much of a obstacle to growth. Chetan, what about commodity prices? One of the points in one of your reports is that there is a general disinflation in Asia, which is good to hear. It's kind of contrast with what the Reserve Bank said in its bulletin yesterday. The State of the Economy chapter said that this is no time to be complacent on inflation, was the sum and substance of their point.
So I think RBI's comment there is more connected to food prices. And our focus was before this food price inflation risk that emerged was on commodity prices, because what we've observed is In Asia as well as in India, bulk of the rise in inflation was driven by commodity prices, or call it cost push inflation. It wasn't because of strong wage growth or demand-driven inflation that was showing up in the data. And to the extent to which commodity prices have come down, even India's PPI is in deflation or WPI is in deflation. That does tend to show up in a core goods component of inflation. And when you look at core inflation in India as well as in the region, the key driver for that was this commodity price rise. And we've seen that there is a strong linkage of commodity prices, i.e. WPI, and then onwards pass through into core inflation. So that's where our confidence was that the inflation outlook is going to be comfortable for the central banks in the region to be able to cut interest rates from the fourth quarter. Bank Indonesia is going to be the first one that goes, and RBI is expected to go in February 2024 with a rate cut.
Okay, you're expecting an RBI rate cut in February 24.
That's right.
Okay. Well, just to read out to our viewers the Reserve Bank sentence, as you said, food price spikes typical of the onset of monsoon drove up headline inflation in June, corroborating the MPC's view that the fight against inflation is far from over and monetary policy has to stay the course on the arduous last leg of the journey to align inflation with the target. Now, just to finish the inflation argument, the Reserve Bank's own forecast is now not going to see a 5% up until the end of fiscal 24. So you still think they will cut without the decimal point being 4 point something?
Yeah, we are expecting inflation to be in the range of 5 in the first quarter of 2024 calendar year. And so we think that with that, the RBI will be able to cut interest rates because in terms of the outlook at that point of time, they'll feel comfortable that they can begin to do the rate cut. Again, we're not expecting a whole lot of rate cuts. We're only expecting a 50 bips of rate cuts in this cycle. But I think the bigger constraint to RBI, I think, food prices should be comfortable. But then more important point for the RBI will be whether the Fed is done with its rate hike cycle. And what I'm seeing is across the region, Latha, all the central banks are hawkish. We just heard Bank of Korea speak last week, and they were also sounding very hawkish. Not because there is big risk to that inflation, but they know that the Fed is not yet done. And I think RBI has also been following something similar as an approach. They focus a lot more on 4% inflation target when they are conscious that Fed is not done. Of course, they can't be so explicit to say that we are focused on the Fed's rate hike path, and they draw our attention to inflation. But I think the bigger constraint for them to begin to cut rates and sound dovish is the Fed rate policy path. And that's where we are also expecting the Fed to do just one more and in July. And after that, we think the Fed is done. And as the Fed is beginning to give that indication by fourth quarter of this year, RBI will be then comfortable taking up rate cuts in February 2024.
Okay. Got that. So using the US as an excuse to not cut and giving food inflation as the excuse. Chetan, the other interesting report that you'll have written in recent times is that FDI flows are indeed coming to India because of the derisking of supply chains. Do you see that? I mean, if you can elaborate more on that, the FDI flows into India, how does it stack up versus peers, and whether that can add points to growth in the years to come?
So that's right, Latha. So what we did is we looked at the FDI outflow data for US and Europe and some of the countries in the region like Korea and Taiwan. And we found two interesting trends. Number one is that India seems to be taking a larger share of FDI outflows from US and Europe. And for Korea and Taiwan, they are investing a lot more in the US. So whatever we are hearing from, the media that there is this supply chain de-risking happening, now we can see that in the hard data for FDI outflows, where people are beginning to, corporate sector in the US and Europe are beginning to de-risk their supply chain and focus more on India away from China.
But actual FDI flows have actually declined in India. I mean, we didn't do very well in the first half data that came from the Reserve Bank. That, according to you, is because companies are not reinvesting, is it?
That's right. Yeah. I mean, that's the trend for the whole region that we have seen, because of COVID shock, profits got impacted. And it's really those impact of that profit deceleration that showed up in reinvested earnings. But excluding reinvested earnings, FDI inflows have been fine. And this story is a global trend. So globally, FDIs have slowed because of slowdown in global growth and profits. But market share for India as well as the region has continued to do well.
Okay. And a final question, Chetan. If we are seeing this India story being touted very strongly. You all wrote several reports, I think, starting November last year. And now you saw the latest report from Capital extolling the current decade as India's decade, asking a question, but to some extent answering it in the affirmative. Do you see Indian growth therefore picking up? I mean, we're doing 6 to 6.5, even before the demographic dividend has kicked in, even before the geopolitical advantage. Do you think that in the decade ahead, 6.5 will be, par for the course and we'll do better?
I think 6.5% is strong. I mean, one can see higher than 6.5% growth rate. But look, I think, when we put this report out that you mentioned, that was in October last, we were getting a pushback on 6.5% growth rate because this is now on a higher GDP base. So we had one line in the report which was saying that, the fact that India is growing at this higher pace and compound at this higher pace on this large a base now, that will be quite commendable, and it will help India to be accounting for about 18% of global growth, or call it 1/5 of global growth. So I think that's a pretty good outcome. I mean, there are obviously upside risks, but I think at this point of time, with the facts that we have and the policy effort that is ongoing, we are comfortable with 6.5% growth forecast.
Okay. But you said there is upside risk to your 6.5 forecast, and I would perhaps bet on that upside risk. We were doing 6.5 even without the demographic dividend and the geopolitical advantage. Just a common sense hunch is that we should be doing 7. On that optimistic note, I know your number is 6.5. Thank you very much, Chetan Ahya, for joining us with your analysis of the Asian backdrop and the impact on India. The stock market's in good cheer. We wrap up on that note on Bazaar. Chart Busters update.